China, officially the People's Republic of China, PRC, is a country in East Asia. With a population exceeding 1.5 billion in January 2024, it is the world's second most populous country after India. China had both export and import, is leading to a positive trade balance of 677 million in thousands of US dollar. Manufacturing, services, and agriculture are the largest sectors of the Chinese economy, which employing the majority of the population and making the largest contributions to GDP.
Over the past decade, China's economy has shown remarkable stability and consistent GDP growth. However, in 2020, the growth rate dropped significantly from 6% in the previous year to just being 2.2%. Despite the sharp decline, the GDP continued to rise. How is this possible? The answer lies in the method used to calculate GDP, specifically the expenditure method, which consists adding the personal consumption of the population, business investment, government spending, and also net exports. Typically, personal consumption includes spending in shopping, foods, drinks, and entertainment, and also traveling. However, personal consumption in China hasn't been as high as one might expect for the world's second largest economy. Data shows that consumption in China has been declining in recent years, and this is largely due to classification on social classes. A significant portion in China's population falls into the lower income bracket compared to other countries, mainly because wages are not sufficient, limiting their spending power and leading many into poverty. So, if personal consumption isn't driving GDP growth, what is? The key lies in China's heavy investment infrastructure. The Chinese government has a strong focus on building and improving infrastructure, including buildings, bridges, roads, and schools. These investments generate returns over time and create employment opportunities, which in turn boost GDP. By investing heavily in these projects, the government stimulates economic activity and sustained growth. China also has been a major exporter of goods, which has contributed to its GDP. A positive trade balance, exporting more than importing, can significantly boost GDP.
China's release from COVID-19 regulations to be the year's most significant economic development. Rather, it has become clear that the reopening was a huge disappointment. Asia's fund managers voiced their fatigue and frustration with China's weak development and the absence of a coordinated government response in a recent Bank of America survey. According to the data, China's GDP expanded 4.9% in the third quarter compared to the same period last year, which was quicker than anticipated. Additionally, its growth was even stronger than it was in the before quarter, growing at an annualized rate of 5.3%. It should now be quite easy for the economy to reach the government's around 5% growth objective for this year. A bank called UBS Financial Services increased its 2023 prediction from 4.8% to 5.2%. Inflation is still a possibility. In the third quarter, China's real inflation adjusted annual growth was 3.5%, which is less than the country's nominal growth, the accounts that for inflation. According to the chart, this indicates that prices for goods and services have dropped by over 1.4%, marking the second continuous decline. This makes the current era in China the worst deflationary stretch since 2009. A decade ago, Guizhou was among the poorest provinces in China. Nevertheless, it has gained recognition for its remarkable infrastructure projects, such as the Bintang Bridge and the Deutsche Beipan River Bridge, which are among the highest bridges in the world. The president has complimented this investment for their tremendous contribution to the province's development. But there's a high debt load accompanying this success. The use of LGFB started, and following a stimulus package worth 4 trillion yuan in 2009, the practice grew considerably. However, because of a decline in property sale earnings and an increase in public spending, the COVID-19 pandemic made local governments' financial problems worse.
In order to prevent this hidden debt problem from continuing to flare up, China's government has taken some drastic measures and policies to combat it. The action was to restructure LGF's debt, also debt for bank loans with longer maturities and lower interest rate in a bid to relieve repayment pressure on local authorities and LGFs with the help of the central government, which instruct commercial banks in 12 heavily indebted provincial level regions. Another approach to solving this issue is to sell some of assets and equities. The net assets into cash will provide more cash to pay off their debts and strengthen their fiscal position. Next, issue and convert the debt to special refinancing bonds to repay some of their off-the-books debts among plans of the resolve hidden debt. This swap would only delay the solution to this problem, but at the same time, they would require the local government to fund a new source of revenue.
For the conclusion, China's economic story begins with a focus on investing over spending on consumption since opening up its economy, particularly since 2000. This emphasis on investment was powered by rapid economic growth, large working age population, and a low dependency ratio. However, the global financial crisis of 2008 changed the game. Return on investment dwindled, nudging China toward a consumption-driven growth model. Despite hurdles like the pandemic, this shift is likely to persist, driven by decreased demand for infrastructure and housing alongside an aging population. Currently, China's economic journey is transitioning towards a consumption-driven growth model. This is characterized by less investment spending and more consumer spending.